and that's where the market found support. Here's 2450. Okay, this is November of 2008. Again, the market's been down here before, and this is where it's found buying support. So 125, 124.50. Doesn't mean we're going down there, but if we go down there, is there a whole heck of a lot of support waiting? Yeah, a couple different times. Okay, so even when you hear all these people talk about all the fundamental reasons, somewhere along the line, trust me, they're looking at a price chart. Even the ones that make fun of price charts at some point are looking at a price chart. Okay, so there's your market look back on the 5, 15, 30, 60, 4-hour, and daily chart. Okay, and let me make a quick commentary about time frames, and inevitably the question I get, which is, do I have a favorite? I do not. I do not, and neither should you. What you're looking for when you're looking at all these time frames is this. Okay? In terms of each one of these time frames and what they're telling you, realize that if you're looking at a market that isn't following through very much because there's a lot of concern or worry or indecision, longer time frames can be very tough to trade because they're not going to move a whole heck of a lot. But consider, if you have a 100 pip day on the Euro US dollar, that's not a whole heck of a lot of movement, is it? Pretty average, maybe a little on the low side, who knows? Okay, we'll actually talk about that in a moment. Talk about price movement ranges. But let's say you have a 100 pip day. On your daily chart, heck, even on your 4-hour chart, you may not get enough movement to trigger a trade and get some follow through. But 100 pips on a 30-minute chart or a 15-minute chart, or most especially a 5, is a lot of movement, and it's probably going to be a couple, market cycle shifts and definitely enough volatility to likely form a trade and trigger it and follow through. So your time frame is going to be reflective of the volatility. Less volatility, it's much harder to trade those longer term time frames. Okay? That's when you're going to go down to a shorter term time frame. If you're nervous about the follow through, if you're nervous about the different news releases that are coming out and you don't want to be in the storm when they come out, the short-term time frame is a good way to be able to get in and get out. Realize that short-term time frames, I just did a radio show and I had a big discussion on day trading, okay? And day trading has such a bad connotation because people kind of liken day trading, if you remember, to those crazy go-go 90s when everybody were hyperactive, tick chart, 1-minute chart, getting in and out of stocks, getting in and out of the few, whatever the market was. And these guys really didn't come off as very professional, a lot of them, sadly. And for whatever reason, the most unprofessional amongst them usually made it to all these specials, and all these negative ideas were associated with day trading. And it kind of upset me because I knew from being a history of what trading has been that day trading is really a risk management consideration. And again, we'll talk more about this in just a minute because I'm really excited to talk about these pip movement ranges with you. But realize when Wall Street was a wall, a big wall built up next to the street, literally, back then, the first types of participants in the market were day traders. They got out flat at the end of the day because it was a risk management consideration. Think about it this way. I love daily charts. In fact, when I was doing a lot of when I first got into the market, before I started doing a lot more active intraday trading, my first few years were just daily charts. That's all I had access to. In fact, I would get these charts mailed to my home, these huge commodity price charts, mailed to my home, and I would update them manually with a pen. I'd call my broker, get the closing day, the closing price of the day, the open, high, low, close, and I'd plot them using a bar chart on my chart every single week, Monday through Friday, until I got my new set of charts in the following week. This was before the internet, so this is the way I was trading, on a daily chart, manually updating my own charts by hand. And it's not that that's not effective, but that was my reality. That's what I had access to. But because I was exposed to the market for such a long time, daily chart setups might take weeks, if not months, to develop, and they're going to have a lot higher upside, but my downside, my risk, my profit target was usually going to be further away, which was great, but sometimes my stop loss was going to be further away too. So the fact that I might be in the market for days, if not weeks, sometimes months, opened me up to a lot more risk. And why? Because people's opinions change, things happen, events, and all sorts of things. So I was left wide open to being in the market for a longer period of time. Well, the exposure to the market is risk. Okay? The most risk-controlling thing you can do is not be in the market, right? But traders manage risk in order to hopefully see a reward. We balance risk and reward, right? So what are you looking for when you're looking at all these time frames? Clarity of psychology. Which one, number one, is going to be the most risk appropriate for you? Some of you might love daily charts, but just because of your account size or even your own risk tolerance, it may not be appropriate. Okay? And then you also, again, like I said, the main thing is the clarity of psychology. Which one of these time frames is giving you the best setup? Which one of these time frames is giving you the clearest reading of the market psychology via the wave? Which one of these time frames is the wave being most respected? Okay? So it's a process I call triage, which comes from the French, to sort. I'm sorting through these charts. I'm not picking a favorite in terms of, oh, I love a 5-minute. Nothing like that. I'm taking all these overall considerations into account to say, okay, is volatility low? Am I better off with a short-term time frame? Is my risk tolerance low because of impending economic events, or I'm going into the weekend, or I'm going to be out of town, or I'm not going to be available at my desk? Are there issues that are telling me that I want to focus on short-term time frames? What's the clarity of the psychology in terms of the wave reading on the time frames? Okay? These are all considerations. All right? Okay, so that's our discussion on time frames and market look back and what you're doing as you're sorting through all these. And this is a huge part of trading, my friends, because a lot of people decide they're going to pick a time frame and just trade that one. Well, it may not be the best time frame to trade for the mood of the market that day, for the type of economic events that are happening, for the volatility that you're experiencing. That's why you need to compare them. And that's why you'll typically see, if you were sitting here in my office, while my charts aren't this small, you'll typically see that I'll be looking at about at least 4 to 6, if not more, charts simultaneously. So I can compare the market cycles, I can compare the setups, I can see the volatility all at one time. Okay?